Well, greetings to all my investment clients. My name is Walter Maziers, your wealth manager's CPA tax advisor, doing our weekly stock market recap as of Friday, August 22nd. I'm recording this on Saturday. But before I get into the details of what the stock market did, need to read this disclosure statement. Just for anybody who's watching this video other than my clients, this is not intended as investment advice or a solicitation to sell or buy any securities. Please seek investment advice from your own advisor. Again, this is for informational purposes only. So at your leisure, both my clients and anyone else watching other than a client, you can stop the video and read the details of the full disclosure. But if you want more detail about myself, Walter Maziers, and Trinity Wealth Solutions, you can go to FINRA's website, brokercheck, finra.org. Just put my name or Trinity Wealth Solutions, and my background should come up, and background about Trinity Wealth Solutions. Okay, so that we got this out of the way, let's get into pretty much a high-level overview of the stock market. Remember, as always, I'm kind of comparing four asset classes: long-duration bonds, QQQ, which is technology, SPY, which is the broad market, and gold. Again, why do I pick these four? These are very distinct asset classes, broad asset classes. And then I'll touch upon a little bit about economic news. So as if you do watch financial news, as you can see, Friday, yesterday, the market had a very nice run up. Technology 1.57, S&P 500 also 1.47. Even gold went up by 1%. Bonds also went up a little bit. What caused the market to react to the upside? Because remember, it was kind of trading, if you look at 5 days prior to Friday, the market was just kind of trading in a range. Couldn't find a direction. It was really waiting. Everybody's waiting for Jerome Powell, Jackson Hole's speech, what he's going to say. And pretty much what he said is, hey, we are open to rate cuts. Well, the stock market loved that. Meaning, remember, the Federal Reserve has two mandates, interest rates and unemployment. So there's a shift right now by the Federal Reserve to kind of say, you know what? Inflation, interest rates, unemployment. Inflation initially for the last 2, 3, 4 months, the Federal Reserve was saying, well, tariffs are going to cause inflation. Well, again, that's not true. Tariffs do not cause inflation. What causes inflation, if you understand monetary system, it's always an oversupply of money and not enough goods. We're in the opposite direction. We don't have money creation, meaning banks are not lending. People are running out of money, tapping out their credit cards. So the money supply is shrinking, where the supply side of products and goods and services has been steadily increasing. So guess what? That's not going to cause inflation. Yes, there could be temporary, increase in goods and services because of tariffs, but that's not going to cause long-term duration inflation. So bottom line is the Federal Reserve kind of pulled back and said, yeah, we've been worried about inflation caused by tariffs. That just hasn't happened. The data doesn't show it. So now they're seeing after a week ago, remember, a horrible jobs report, the Federal Reserve really took notice of that and said, well, I think the economy, unemployment is not looking so great. The job market is not looking so great. There's definitely a slowdown in the economy. So that's why Chairman Powell on Friday, speech from Jackson Hole, he He says, hey, we're open to a rate cut. He didn't say how much. The prognosis experts are saying could be from a quarter point to 0.5%. We'll just have to wait and see. There's going to be more data coming out, and that may push even the Federal Reserve to cut rates. If they cut by 0.5% in September, the market's it's going to go up. That's what the market's been waiting for. But longer term, that's not a good sign, because when interest rates are being cut, there's a reason, and there's a misunderstanding even by the financial media. They think interest rates cuts are great. No, that's not good, because that means when interest rates are going down, there's a slowdown, economic slowdown, and potentially a recession. So those are not good signs. Quite opposite. If interest rates are steady, even going up, that's a signal that economy is strong and there's no worries about inflation. So there's kind of a misunderstanding what interest rates really do when they're going up versus going down. So going down, that's not a good signal. Short term, the stock market thinks, okay, that's great, but eventually it winds up that it's not so great, because there's going to be economic growth. More people are starting to lose jobs. They're concerned. Consumer sentiment is going in the wrong direction. So it's just a matter of time. Remember, the stock market does not reflect the real economy. It's really, I hate to use the word, it's almost like a casino. Well, people think, hey, the market is just going to continue to go up, and people put money into the market. It's going to drive the market higher. That's got nothing to do with the fundamentals of the economy, which are deteriorating. There's definitely slowing growth and potentially maybe a recession at some point. So on that background, that's why the market really went up. So again, the momentum right now, the research we're getting from our technical analysis company, they're saying that right now the trend is up. How long? Is it a week, 2 weeks, a month? Nobody knows. So we get research that says, hey, the trend, and these are probabilities, there's no guarantees, that the trend is up. And more so now, even with Powell coming out and saying they're open to interest rate cut. So stay tuned. I think the market is gonna, have a positive upside for the next 2, 3, 4, 5, even 6 weeks. We just follow the trend, and if the trend turns, then we will pull back out of the market. Remember, all our clients right now have exposure, 60% exposure to the stock market. So 30% in right here in QQQ, which is technology, 30% in SPY, and 40% in U.S. Treasuries, BIL, which is the short-term U.S. Treasury notes, paying about 4.2, 4.3%. A pretty good rate for no risk in your portfolio. So that's looking at 5 days. As I said, it was kind of, the market was trading in a range and waiting for something to spark, that upside. And that spark was really the announcement by Jerome Powell that they're open to cutting interest rates in September. So if we look at 6 months, remember April, we had that huge pullback. For 6 months, the market is up. Technology about 9%. The broad market about 7.8%. Bonds are still out of favor. That's something at some point we're going to get into. I don't know if it's in a month or two. The time when interest rates really start to come down pretty aggressively, that's where we're going to consider going into long duration bonds. One of the things that's not talked about is interest rates or the bond market. Remember, the bond market is 3 times as large as the U.S. stock market. What is the bond market saying right now? They're saying interest rates are going to come down because there's risk of a recession and there's really no risk of inflation. So meaning economic growth is slowing when interest rates are going down. And it's opposite. When interest rates are going up, that means, hey, people can afford a higher cost of interest, whether it's business loan or because they have good income, good positive trend economic to the upside. So which way the market is going to go long term, we're kind of overdue for correction. Again, these are probabilities. Nobody knows for sure. Nothing goes up in a straight line. This is a 5-year look at the broad market, and as we can see, back in March, April, it was actually pulled back almost 20%, and then it's back up. So it's hitting all-time highs. Those are warning signals. That doesn't mean the market is going to crash, but it's telling us the probability of some kind of reset pullback is getting higher and higher and higher. If the market continues to go higher, people get complacent, FOMO, fear of missing out. They just keep plowing money in and in and in. And back in March, we were really out of the market around here because we didn't know if this was the start of a major pullback. And that's kind of where we're at right now. So if we look at, let's go back to the market cycles. If I find there we go. Remember I talk about market stages. And that's our concern right now is, there's stage 1, stage 2, stage 3, stage 4. Many experts are saying in the cycle of the stock market, we're in stage 3. The thing that we don't know is how long this stage 3 topping can last. It can be a year, it can be 2 years, but the risk is definitely here because the markets have topped and there isn't that much more room for the market to go up. But as I mentioned also last week, the greatest opportunity to make profit or make money for clients is stage 2, when markets are recovering from a major reset, and then when markets are declining, a major pullback. This is the part, stage 4, that most investment advisors and most industry says, well, either get out of the market or it's tough to make money. No, if you get into the right asset class, there's tremendous potential probability of making money. And we did that for clients in 2020, I believe, where this was COVID time. And there was a pullback, but interest rates started to come down aggressively. We got into long duration bonds, and I think on average for 1 year, clients were up 25%, where the market was down about 40%. So a huge difference. So as you can see, there's no certainties in the stock market. We just we rely on our research company to give us kind of a trend line where right now the trend is up. So let's look real quick at some economic news. I talked a little bit about what sparked Friday's rally was Powell's remarks talking about they're open to lowering interest rates in September. Some negative news, initial jobs claims rise. What does that mean? There's more people losing their jobs. Consumer sentiment, which is not here, but again, it fell. This is through University of Michigan, where it kind of gauges consumer sentiment. That doesn't mean they're still not spending, but they're getting worried. So they may be pulling back. They're worried about, hey, am I going to lose my job? Am I going to have my job? Another negative manufacturing indicator is the Philadelphia Fed Index unexpectedly fell back into negative territory and suggested weakness in manufacturing sector. So there's a bunch of the other First quarter state GDP. The Bureau of Economic Analysis reported that U.S. gross domestic product decreased in 39 states during the first quarter of 2025. So kind of a positive. Canada lifts tariffs. They had Canada announced it would remove its 25% tariff on about half of the U.S. goods it has targeted since March in an effort to reset the trade relations. So that's a positive, but the economic landscape is not looking good. So we just have to wait. We just have to wait. Right now, our clients are capturing about 60% of the stock market. We don't want to go 100% because we don't know what the market could roll over and have a dramatic decline. And that's really what our added value to our clients is. Protect, protect, protect. Remember, we work with mostly retirees, so we want to protect and grow your money consistently. We're targeting longer term, a consistent rate of return of about 10%. And we're almost there right now for the last year or so. So stay tuned for next week. Stock market recap. As always, to my clients, if you have questions or concerns, just give me a call and we can go into further detail, do a deep dive into your own portfolio to see how it's doing. So thank you for watching. Hope you have a great weekend, and we will see you next week. Take care. Bye now.